Good day everyone. Today, I would like to briefly introduce Sime Darby Plantation Berhad, also known as SDP. SDP is one of the world's largest vertically integrated palm oil producer and is headquartered in Malaysia. The company operates plantation and downstream activities across Malaysia, Indonesia, Papua New Guinea, and also Solomon Island. SDP manages nearly 1 million hectares of land and plays an important role in the global edible oil and agribusiness industry. The company was listed as an independent entity in 2017 after it demerged from Sime Darby Berhad. In recent years, SDP has also expanded into green and sustainable initiatives such as renewable energy, industry park development, and peatland restoration. These efforts show that the company's commitment to sustainability, innovation, and long-term growth. In conclusion, Sime Darby Plantation is not only a leader in the palm oil industry but also an important contributor to Malaysia's economy and global food supply.
So for the liquidity ratio, we have current ratio. Based on the current ratio for year 2024, is slightly less liquid than year 2023. So you can see that year 2024 is only RM1.36 in current assets for every RM1 in short-term debt compared to RM1.48 in year 2023. Next, we move to acid test ratio. Next, in acid test ratio for the year 2024 still comes out to be less liquid. It has only 55 cents in cash and accounts receivable per RM1 in current debt compared to 61 cents for year 2023. So next we move to days in receivable. However, the days in account receivable shows that year 2023 is slightly more liquid than year 2024. On average, year 2023 collected its receivable in about 44-38 days compared to 44-64 days in year 2024. Thus, year 2023 is a bit faster at collecting its receivable. Next, we move to the account receivable turnover. The account receivable turnover ratio also support this, where for the year 2023, it collects more receivables slightly more quickly, which is 8.20 times than year 2024, which is 8.18 times. For the days in inventory, we see that year 2024 is moving its inventory faster than year 2023. So year 2024 takes about 82.52 days on average to sell its inventory compared to 89.20 days in year 2023. So this indicates that year 2024 is more efficient in converting its inventory into sales. Next, we move to inventory turnover ratio. For inventory turnover ratio, the pattern is very consistent. Year 2024 records a higher turnover, which is 4.42 times per year compared to 4.09 times per year in 2023. A higher turnover means that year 2024 is replenishing its inventory more frequently. It is showing that for the 2024 year is more stronger inventory liquidity. We move to the profitability ratio, which is operating return on assets. One of the most important ways managers to create shareholder value is by earning strong profits on asset which they have invested. So based on the operating return on asset ratio, year 2023 earned higher return compared to year 2024. As you can see, for the year 2023, generating 5.5 cents of operating profit for every RM1 of assets, whereas you can see that year 2024 generate only 4.8 cents. So we move to the operating profit margin ratio. In terms of the operating profit margin, year 2023 again performed better, achieving on OPM of 4.2% compared to 3.7% in year 2024. So you can see that this result indicate that year 2023 managed its cost of goods sold and operating expense more effectively than year 2024. Next, we move to the total asset turnover. For the total asset turnover, year 2023 shows like RM1.30 in sales for every RM1 of assets compared to RM1.29 in year 2024. Although the difference is small, it contributes to the higher operating return on assets for year 2023. For fixed asset turnover ratio, lastly, in the fixed asset turnover ratio, year 2023 again demonstrate stronger performance, recording 3.13 times per year compared to 2.74 times in year 2024. So this suggests that year 2023 had a smaller investment in fixed asset relative to its sales, contributing to both higher total asset turnover and stronger operating return on assets. Financing decision ratio, which is debt ratio, for year 2024, finance only 54.9% of its asset with debts, compared with 53.3% in year 2023. Thus, year 2024 is more risky than year 2023 because it is relying on a higher proportion of debt to finance its asset. The last one is return on equity ratio. For the return on equity ratio, so you can see for the year 2023 and year 2024 are 9.96% and 18.3% respectively. Hence, the owners in year 2023 are receiving much lower in their equity investment compared to year 2024. Although year 2024 has a lower operating return on asset, which is 4.8% only, than year 2023, 5.5%, it still records a much higher return on equity. This shows that year 2024 is using more debt to increase returns to shareholders, which helps the company achieve higher return on equity even with lower return on asset.
As we know, Sime Darby Plantation is the world's largest palm oil by planted area, so they might be faced
many factors that affect their current and future performance. One of it is global audience. Sime Darby Plantation operates in Europe, China, India, and the United States. So each country expects different product specification, pricing structure, and customer service level. And some countries impose strict sustainability standards such as certified sustainable palm oil. So when negative global perception of palm oil will reduce demand and pressure Sime Darby to maintain strong sustainability practices. Okay, the next one is global web experience. Sime Darby Plantation provides sustainability reports, certifications, and product details through global websites. So the international buyers use the information as a proof of traceability, sustainability, and transparency. A weak website may decrease investor trust and affect confidence in the company. Okay, next, social and environmental challenges must be considered to remain the operation of Sime Darby Plantation. For example, worker welfare and community expectation is required responsible management to maintain trust and social license to operate. And environmental protection is very essential to meet global sustainability standards. Climate risk can reduce yields and increase operational costs, and labor allegation may harm reputation and weaken market confidence. So the overall impact will affect both current performance and long-term business sustainability. Last but not least, economic and regulatory landscape is one of the factors that may affect current and future performance. So this factor is actually overall economic condition and rules or law that shape how company operates. It includes global demand and currency fluctuations that affect business performance. Strict rules or shift in global market may increase costs and reduce demand. So overall effect can influence revenue, profitability, and long-term financial stability.
How might the organization better capitalize on non-financial factors? First, strength in the market. Brand strength, customer loyalty, product quality, and sustainability certification can all help Sime Darby maintain or grow its market share even without focusing on financial measures. For example, Sime Darby's social and relationship capital shows its partners with more than 60 brands across automotive and heavy equipment sectors in the Asia Pacific. Second, workforce capability, good training, safe working condition, and positive workplace culture improve productivity and reduce turnover, supporting better operational performance. For example, Sime Darby committed to provide equal opportunities in its workforce by providing fair rewards to all employees. Third, corporate image and trust. Strong environmental practices, ethical labor treatment, and transparent governance boost Sime Darby's reputation. It helps attract more buyers and maintain trust in global markets. For example, Sime Darby maintains a zero-tolerance approach to bribery and corruption towards achieving greater governance. Next, infrastructure and operational assets. Modern, well-maintained facilities increase efficiency, reduce breakdowns, and ensure smoother production, which improve overall output and competitiveness. For example, Sime Darby approach to sustainability to minimize carbon footprint and investing in renewable energy structure. Lastly, innovation and proprietary technology. Patents give Sime Darby a competitive advantage, help improve crop yields or processing efficiency, and protect the company's innovations from being copied by competitors. For example, Sime Darby, known as SD Gusri Berhad, has their specialization cover the entire palm oil value chain like milling and processing.
Every company might face the risk to the company's financial performance, either internal or external, as same goes to Sime Darby Plantation. One of the most significant internal risks to the company's financial performance is technological changes and system failures. The company may struggle to keep up with new technologies. Sime Darby Plantation might face breakdown in machinery, digital systems, or lack of modern technology that affects productivity. The second internal risk that Sime Darby Plantation is facing is labor and human resource issues. Sime Darby Plantation might face challenges such as labor shortage, skill gaps, high turnover, or conflicts between workers and management. These problems tempt the company to lose high potential personnel. Losing talented staff can weaken decision making, slow down innovation, and reduce operational effectiveness, which can negatively affect long-term performance. The third Sime Darby Plantation is facing is operational inefficiency. Because of Sime Darby Plantation's operation does not occur day-to-day operations optimally, it leads to lower productivity and higher costs. In consequence, these problems limit the access to premium market and threatening the company's long-term competitiveness.
In this part, I will explain to you about projections and recommendations. Regarding Sime Darby Plantation, it has significant long-term potential, especially for individuals' interested in sustainable agribusiness. The significant increase in ROE and sales growth outweighs short-term financial worries. For the first point, is about revenue growth. Ratios show a decrease in both total assets turnover and fixed asset turnover. Sales rose from 48 million and 288,000 Malaysian ringgit to 67 million and 132 ringgit Malaysia, equals to 39% increase. For the second point is return on equity. ROE ratios have virtually quadrupled from 9.96% in 2023 to 18.3% in 2024, indicating successful capital utilization. For third point, inventory turnover. Inventory turnover rose from 4.09 in 2023 to 4.42 times 2024, showing quicker inventory movement and improved storage efficiency. For last point is days in inventory. Days in inventory decreased from 89.2 to 82.52 days, showing improved operational efficiency. For second part, based on my knowledge, my forecast for Sime Darby Plantation SDP in the short term is moderate growth with considerable margin pressure from growing expenses and debt dependency. Liquidity will remain an issue. For a long term, stronger performance is projected if sustainability measures, mechanization, and worldwide market growth are successful. ROE is expected to stay attractive, making SDP a great long-term investment. Nevertheless, lenders should keep a careful eye on debt levels. First, revenue growth outlook. Sime Darby Plantation, with sales increasing considerably from 2023 to 2024, 39%, is expected to maintain consistent top-line growth. Expansion into sustainability projects like solar farms, green industrial parks, and reduced manpower shortage will drive output development beyond 2025. For second point, operational efficiency. Sime Darby Plantation's operation occurs through day-to-day operation optimized. It improved the days in inventory from 89.2 to 82.52, indicating increased efficiency. Continued emphasis on mechanization and digitalization is projected to boost productivity and cut costs. This efficiency trend increase resistance to global palm oil price volatility. For the last part, for my presentation, is about my recommendation to Sime Darby Plantation Company. For the first point is strengthen liquidity management. Issue current ratio 1.48 to 1.36 and acid test ratio from 0.61 to 0.55 show weakening liquidity. The action that need to be taken is improve working capital management by accelerating receivable collection and negotiating longer payable terms. Maintain higher cash reserve to cushion short-term obligations. Explore short-term financing facilities to stabilize liquidity without over-relying on debt. For the second point, manage debt prudently. The issue is debt ratio increased from 53.3% to 54.9%, raising financial risk. The action need to be taken is balance debt financing with equity to avoid over leverage, refinance high cost debt to reduce interest burden, use debt strategically for growth projects but ensure repayment capacity is safeguarded. In the conclusion, Sime Darby Plantation should prioritize liquidity and debt management while continuing to improve operational efficiency and sustainability measures. SDP can assure long-term growth and remain an appealing investment by strengthening cost controls, enhancing cash flow, and preserving reputational strength while lowering financial risk. That's all from us. Thank you.